Most of crypto had a very tough time in the last week. Many altcoins went down, but the Move token is up. Now, why is that the case? Let's have a look at the on-chain data. Let's see who's buying and selling here. And let's try to figure out whether or not it still makes sense to buy some Move tokens. Now, the long-term development of movement isn't that great. Since December 2024, we are down 76%. Now, the Move token is listed on Ethereum. And what we see over here is the relative performance of Move to Ethereum on a logarithmic scale. So we can see the recent rally a bit better. Initially, the Move token traded in tandem with Ethereum. Sometimes Move was expensive, sometimes Ethereum was expensive, but in general, the ratio held up relatively well. Then came a massive crash in April and May of this year. And this here is our recent recovery. Now, what's going on here? There is a good explanation for the long-term underperformance of Move, because over here we've got the tokenomics, as in how much supply is circulating over time. And while the project started out with 2.2 billion tokens, we are now at 2.5 billion. And 1 year from now, we'll be at 4 billion. So there will be roughly 60% of growth in the supply. The question is, can the demand grow as quickly as well? This is probably what a lot of people doubted, and that's why the price tended to go lower even before the massive unlocks. But again, what's causing this recent rally? Is it the ecosystem? Is it the fundamentals? I don't think so, because when we look at the total value locked, so the capital that's on the chain, there was a nice run up that lasted until the 26th of April. But since then, capital is flowing out of the chain. The 26th of April was over here. And so with the outflows, the price decline accelerated further. The project is not dead. There is still development. So you see over here is the GitHub repository, and there are changes committed by the programmers regularly. So that's not the problem. Popularity isn't necessarily a problem either. So on Twitter, now known as X, there are 187,000 followers. That compares to 36,000 holders on the Ethereum chain. And this is very interesting because usually we don't see that much more followers in social media compared to holders on chain. So either there are a lot of holders off chain, or the numbers on social media are manipulated. And so let's try to dig a bit deeper. Let's have a look at the on-chain metrics. How many of those 36,000 holders actually are retail? How many of them are whales? And what are those people doing over time? Who's buying, who's selling? What we see over here is the number of retail investors on the left, the number of whale investors on the right, and something in between in the middle. So we go 10x in minimum holding thresholds for each of those charts. So to be counted on the left, a wallet has to hold at least 5,000 Move tokens. At the current price, that's roughly $1,000 worth of the token. We can see that in the last months, we didn't really see much accumulation. So the number of retail investors didn't go up. The number of medium-sized investors even went down, and the whales, again, their quantity declined as well. So no purchasing, and then of course the price tends to rather go down. But what's interesting is, again, we see this recent rally, right? The appreciation of 41%. But we don't really see this in the number of holders much. Yes, there are a few medium-sized retail investors, so people with $10,000 worth of the token. That number did increase a little bit, but the number of whales did not. The number of retail investors also barely changed. So something else must be going on here that's creating a rally like this. I think the answer to the puzzle is short-term leverage, because again, the tokenomics of the Move token are very bad. There's all this additional supply hitting the market, and so there are more and more people that probably bet on falling prices. Have a look at where the price discovery really happens. This is now the movement token with its trading volume, and most trading volume happens on Upbit on the spot exchange. So that's 159 million worth of trading volume. On the perpetual futures market though, we see more trading volume. We see 453 million. So really the price discovery happens on the futures, not on the spot market. And so have a look at the futures. This is the funding rate of Move over time. A chart like this is not common. For most perpetual futures, we see positive funding rates. So this being green, not red. So usually the longs have to pay the shorts in order to get more price exposure, in order to lever up their exposure. When the shorts have to pay the longs, and this is what's going on with Move, when it costs money to bet on falling prices, that means something is iffy around the project. That means the vast majority of people that speculate on the price, on the perps, are betting on falling prices. And again, we've already discussed why that is, right? It's simply more and more tokens hitting the market, while at the same time, nobody is buying anymore. And so what's happening here very likely is simply a short squeeze. Have a look at the open interest. This recently shot up, while at the same time, the shorts got liquidated a lot. So again, when a lot of people bet on falling prices, that incentivizes the market makers to move the price in the exact opposite direction, to take advantage of those liquidation fees. Have a look at the top 100 cryptocurrencies in the last month. Pretty much everything is red. Yes, there are a few outliers, but have a look at what Bitcoin did in the last month. Bitcoin went down by 1%, or to be more exact, 0.9, while again, the vast majority of the top 100s is losing value. And this is a very common occurrence, again, because of that nasty token inflation that's prevalent across many, many altcoins. Now, the token inflation is not a problem if enough new investors come into the space. When there's a lot of attention on crypto and the system is growing quickly enough, it's not a problem. But currently, nobody is looking at crypto. Everything that's currently pushing up prices is institutional demand. It's demand via the ETFs and via the Bitcoin treasury companies. It's the big people that buy the safe assets. They're not buying the small altcoins. The small altcoins are bought by retail. And when retail is gone, it means the alts are doing very, very poorly. And we can also zoom out a little bit, right? We just have a look at the smaller altcoins over the entire year. The picture looks extremely similar. And in the last year, Bitcoin went up by 50 to 60%. How many of those smaller alts outperformed? It's 1, 2, 3, 4. 4 out of 100 altcoins did better when we look at the smaller ones. And it's not just that most altcoins tend to do worse than Bitcoin most of the time. It's also that some of those altcoins have such an aggressive tokenomics supply schedule that the underperformance is extremely constant. Now in US dollars, sometimes those tokens go up because all of crypto is going up. But relative to Ethereum or Bitcoin, they tend to just go down very consistently. This, for example, is Balancer relative to Ethereum. It had a very similar aggressive supply schedule to move. And so here's the missed opportunity. Most people just then forget about the altcoins altogether. They say, okay, I just buy the S&P 500, I buy Bitcoin, maybe Ethereum and Solana, and that's about it. I don't touch the altcoins. But I think that's a mistake because we can just flip this chart around. We can go long Ethereum and short Balancer, and then we get this kind of return. And this is actually what I've done consistently over the last years. This is my performance over the last 4 years. A bit less than this. So on the x-axis, we've got my monthly performance. And the gray line over here shows what I would have gotten had I just dollar cost averaged into Bitcoin. But instead of just dollar cost averaging into Bitcoin, I got this black return here. So more than double the portfolio now. And again, that's because of charts like this. It's because we are betting on altcoins doing worse than Bitcoin, which is true most of the time. I used to do those relative valuation trades mainly with decentralized finance like borrowing and lending platforms like Aave. So I was borrowing the token I was bearish on that I didn't like, and I then went long the token I was bullish on. Recently, I'm changing my strategy to use mainly perpetual futures. So I started doing this 2 months ago. I started the test with a 40K portfolio. Now that went up by more than 30%. Here, by the way, I forgot to set a proper stop loss and I got short squeezed out of the position. Without that short squeeze, which by the way happened in the launch coin token, this would have been way more consistent. But still, I'm very happy with that. Roughly 30%, somewhat constant gains over the course of 2 months is much faster compared to what I even had long-term using borrowing and lending. And so I'm of course sharing my trades as well, and the community is copy trading those trades. This is over here, a few examples. So with the correct leverage and the right risk management, we can make very nice gains. And it's always great to also get that feedback, right? I did a screenshot of this because I don't want to reveal the name. But yeah, after the first trade on those perpetual futures, the annual membership was already paid. I just got that feedback a few days ago. Now here's the thing, using perpetual futures and using leverage and doing proper risk management with stop losses, etc. It's not as straightforward compared to just buying and holding a meme coin. And that's probably why most people don't do it. But I'm trying to solve this problem in two ways. The first way is I'm simply presenting how I'm doing this in dedicated tutorial. So what you see over here is the premium membership website, and we've got this tutorial over here using perpetual futures on Hyperliquid, and we've got this one over here, risk management with relative valuation bets. Very, very important because you don't want to end with a drawdown like this. So with those two videos, you should already be good to go. But I'm also working now on the second solution, because for the people that have a lot of capital but don't have a lot of time to learn everything, I want to just enable copy trading. So the returns that I'm making can be yours very soon as well. I'm opening up a copy trading mechanism. Now that copy trading will be enabled for the annual subscribers because it will start as a beta project. Because I want to see how the platform behaves with larger amounts. I want to see whether or not we get hunted for our stop losses, how it works with withdrawals and deposits, etc. So I have to launch this with a subgroup, and I will do this for the annual subscribers. So the monthly subscription is just $125, so you can simply just go through those tutorials, copy trade me manually through the trades that I announce in Telegram. But if you don't have time to do this and instead you've got capital, you can also sign up for the yearly. So that's now 10 months worth of premium. You do save 2 months per year. And right now, I won't keep this forever. It also includes a one-on-one Zoom call with me, if you're interested in that, to also look at your other assets, not just crypto, but also traditional finance. See if your asset allocation makes sense in your particular circumstance. A link to premium should directly pop up over here on the screen. Just click on that. It will lead you to the sign up website. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.